All right, let's jump right in. Today, we're taking a close look at the latest numbers from home builder Meritage Homes. Now, on the surface, this quarter looked like a home run. But peel back a layer and you'll find something that had investors hitting the sell button hard.
And that right there is the big mystery we're going to solve today. I mean, think about it. Meritage beats on earnings, beats on revenue, and the stock tanks 6%. What in the world is going on? What did the market see that the rest of us missed in the headlines? We're going to dig in and find out.
So here's our game plan. We'll start with the earnings paradox. Then we'll check out the Meritage playbook from management's perspective. After that, we'll try to figure out what the market was thinking. We'll look at the foggy guidance they gave, and then wrap it all up with our final verdict.
All right, first up, the earnings paradox. This is really a tale of two tapes, two completely different stories being told by the numbers. Let's start with the good stuff.
So check this out. First up, the good news. Earnings per share, they had a solid beat, coming in 2.5% above what the street was looking for. That's a definite win.
And it wasn't just the bottom line. The top line, revenue, looked great too. Another beat, this time by just over 2%. So you're looking at this and you're thinking, okay, great quarter, right?
Wrong. This is what happened next. A 6% drop. The market just hammered the stock right after the news came out. And that is the disconnect we need to get to the bottom of.
And just to put it all in one place, look at this table. You've got EPS beating. You've got revenue beating. They even closed more homes this year than last year. I mean, if you just looked at this snapshot, you'd think the stock should be flying high.
Okay, so given those strong headline numbers, you can bet management came out swinging on the earnings call. They wanted to make their case, and it all revolves around their specific strategy. So here's the heart of their playbook. It's all about building spec homes. They don't wait for a buyer to sign a contract. They just build. This creates a ton of move-in-ready houses that people can close on super fast. And how well did it work? Get this, a 208% backlog conversion. That is insane. It means they sold every single home they had in their backlog and then sold even more homes that they started and finished all within the same quarter.
Management also pointed to this, their growth engine. They're opening new communities like crazy. They hit a record, an all-time high of 312 active communities. That's up 9% from last year. This is them basically saying, we're on the offense, we're taking market share.
And their last big talking point was about being smart with their money. They actually cut their budget for buying new land by a massive $500 million. Now you might think that's a bad sign, but they spun it as a positive, saying, look, we're being disciplined, we're taking that cash and giving it back to you, the shareholders, through buybacks and dividends. So management laid out a pretty compelling story, right? But the market wasn't buying a word of it. So let's flip the coin and try to figure out what was going through investors' heads when they hit that sell button.
And this slide really nails it. It's the two stories, side by side. Management says, record community count. The market screams, yeah, but your margins are collapsing. Management brags about that insane backlog conversion, but investors fire back, sure, but you had to cut the price on every home to do it. And that smart capital allocation? The market saw it and thought, looks more like they're scared about the future.
And that brings us to the absolute killer detail, the number one reason for the sell-off, gross margin compression. Their profitability got crushed, falling a whopping 480 basis points. And why? Because to get people to buy homes with high interest rates, Meritage had to offer massive incentives, basically paying down the buyer's mortgage rate for them. And every dollar of those incentives came straight out of their own profit.
So the market was already spooked by the margins. But their fears got a whole lot worse when management started talking, or maybe when they stopped talking, about the future.
Take a look at their guidance for next quarter. It's cautious, to put it mildly. They're telling investors to expect fewer home closings, less revenue, and the real gut punch, they expect margins to get even worse, dropping to around 20%. That was a huge signal that the pain isn't over.
But this quote from the CFO is what really sent a chill down the market's spine. When they were asked about the rest of the year, she basically said, we have no idea. We have 0 closings lined up for Q4 yet. Because their business model is so fast, they have no visibility. And in a shaky market, hearing we have no visibility is the last thing investors want to hear. So they pulled their full-year guidance completely.
Okay, so we've heard the bull case for management and the bear case from the market. Let's put it all together and figure out what this means for the stock going forward. It's time for our verdict. So, looking ahead to the next earnings call,
We think they'll probably hit their Q3 numbers. That's not the issue. The entire market is going to be laser-focused on what they say or don't say about Q4. Until we get some clarity there or until interest rates change, we see the stock just bouncing around in a range. Which leads us to a cautious, neutral sentiment. They're running the business well, but they're fighting a losing battle against those profitability pressures.
So, that brings us to our official rating from Meritage Homes. We're calling it a market perform. Look, they are executing their spec strategy brilliantly, but they are swimming upstream against a powerful current of high interest rates. And that's just going to keep squashing their margins and, by extension, their stock price for the foreseeable future.
Okay, so that's the serious analysis out of the way. Now let's have a little fun with our not financial advice segment where we dream up a wild, low probability, but plausible trade. We're calling this one the Fed Pivot Slingshot. Here's how it would work. Step 1, the catalyst. The Fed shocks everyone with a big, aggressive rate cut late in Q3. Step 2, the impact. Mortgage rates just fall off a cliff. All of a sudden, Meritage's huge inventory of spec homes isn't a liability, it's a gold mine. They can stop offering those profit-killing incentives, and their margins just explode higher almost overnight. So, step 3, the trade. You'd use a risky, short-dated call option strategy, betting on a massive, rapid comeback for the stock as the market scrambles to reprice it.
And of course, let me be perfectly clear, this is not financial advice. Seriously, thanks for tuning in.